Good morning, everyone. Hey, it is Shooter Scott Henderson. Hey, and we are going to go over primary waves, punch card, ETFs, and of course, at the end of our presentation, please review our disclosure. Okay, global trend ETFs, our technical analysis for September 2024. Okay, I want to talk about market sentiment a little bit. We are what I would classify as really overbought here, especially considering the circumstance. Anytime we don't get at least a 382 retrace on a bullish leg forward, it makes me nervous because there is a greater likelihood of a good flush, and those are things that still spook me, especially from a scalping standpoint and a swing standpoint. And I don't like to have long positions. However, at the moment, we have a lot of new setups. So as 2024 has taught us, my bias is not necessarily on point every single time. If anything, I'm too blasted conservative at times. So we'll take that in context and move forward with that. Okay, let's start off with XLRE. Now, real estate is still a favorite of mine. We basically pegged these lows off of my primary wave setup at 35.57 on this real estate select sector spider ETF. I expect to target 49. Now, it's a little late to enter here. However, a person probably could sell 40, 42, 50 if they have that strike cash secured puts to earn some revenue here, and I would be fairly confident that we stick here. The only thing that might give us a back test or another buying opportunity if the Fed doesn't cut. So that's my thought. So I don't really get concerned unless we break below the breakout line, which is just a little bit above 41.17. Now, as far as strategies, you can still buy the breakout here. Anything above 44.56, we get any type of back test. But I don't know that I would chase calls here unless we get a back test. We get a back test, 50% of the last leg, 38.2% fib in the last leg, then I might do that. Otherwise, I would just think about the cash secured puts in the 40.50 to 35.50 range would be the optimum place to sell them. All right, let's look at IPO. Another, something I think is building. There's a lot of chatter about IPOs coming up this year, especially as rates start dropping a little bit because it's a little cheaper to finance them. So we'll see if that manifests. But the chart looks pretty good right here, where we've got prior support right overhead, two different levels at the 45 and then up at the $50 level. You'll see those blue bands. By the way, the pink bands are resistance and the blue bands are support. Now, in every Elliott wave count, typically at your either primary waves or your cycle waves, blue cycle, green primary waves, okay? You have a minor resistance and an extreme resistance. And in this case, this is a perfect example of that. Minor resistance, extreme resistance. Minor resistance, support, extreme support, okay? So obviously, as soon as this broke and that minor resistance held as resistance, that was your tell to get short. 2 cents on the chart. So IPO, I like it to about 50.37. Now, the only thing is this was outside the count, this retrace here, and ironically, I saw that on a number of charts. And that's because the tech is trying to measure the waves, instead of me manually measuring the wave. So that's an outlier event. That flush is not something that this leg predicted. It's an outlier. So depending on how you view theory, you either can include that in your view or exclude it. I like to include it, so I consider this as my immediate support, that second standard deviation down, which is a lot of room from where we are. So, if I was going to use a stop here, and I don't have stops actually marked on these charts for a reason, because they may be sitting here for a month and I don't want somebody to view the chart 2 weeks out and the stop change. So this off number down here, off of this before we broke down, is probably a good spot. So probably about 41.25 is where I would leave my stop on IPO. I like, let me get to my write-up, not recalling specifically. Breakout above 42.74, you could chase calls, $50 calls. I would go January or common shares, of course. This is something you could scale into. I think this is something that sticks with us. I think IPOs build into 2025. which obviously could give us a push back up towards our resistance at 70 bucks. So there's potential some decent upside on this as well. So I do expect to hold that into 2025. All right, now EWA, we basically, this is a China play. Sooner or later, China's going to print some money and throw it into their economy. And they're going to print enough money where they get some growth, because they're starting right now. The consumer is just decelerating, almost like a depression level. The challenging part of that is, outside of AI, I think we would be doing the same thing as they would be doing. It's just we have the machine that they don't have currently, driving tech and everything else. And not only that, it's extremely expensive to adopt AI. So the number of companies, I think, in China that have the book to jump on board is going to be slim. And all of their main tech companies are so screwed up because of their regulation. I don't know that they get organized enough to get on the bandwagon unless there's a specific funding mechanism with the federal government. So, but looking at EWA, as far as Australia is concerned, I expect commodities to come back. I mean, we have a nice, clean, divergent low here on our two. I mean, nice and clean. Look at the spread on that. Nice grouping as far as time within the legs of the waves. Now, leg is A, B, and C. So I also call it a cycle. There's minor cycles, bigger cycles. Like this is A, B, and C. So those are all forms of a cycle. So we got these nice little bounces. Now this appears to be our next bounce. So our final bounce should come in. Now we're going to know soon if we break out, which I think it more likely tests this band. So we're sort of waiting and seeing that it's going to be a catalyst coming from China, putting a couple bucket loads of cash into commodities to try and accelerate different manufacturing sectors. So, but our target ultimately on a breakout would be 34.55. It might just sit where we are. I just want to give you a heads up on this. This might be something that just sits. But I think China does move at some point. Might be 2 months, 6 months, whatever. Once they start pumping money into the economy in size, Australia should be a benefactor, and this could give us a pop back up to 30 bucks easy. So that would allow you to make a decent profit on it. Okay, let's look at DGS. Now, one of the biggest benefactors of lower interest rates is going to be small caps, because inherently smaller companies have to borrow more money because they don't have the cash reserves of the big whales. All right. So the count suggests this. And by the way, here's that outline count again, that either that or I've got something wrong with the algo I don't know about, but we'll figure that out if that is the case. So at this point, we're going to test this breakout line right around 53. And then we should back test these highs up around 56.20. And then we're going to know pretty soon if we're going to break out. This is a pretty misogynist wave. They don't generally change when they're like this, because we have that, notice the push, like for example, this acceleration here. We don't really have that acceleration here anymore. So, however, if you look at the volume that's coming in here, there's a lot of interest in this, much more than usual. If we go back, I don't have it on this chart, but back over here, you have the similar leg before this leg started. So, there's a couple things that I like the way this looks. Bollinger Bands, for example, getting that little bit of a squeeze. It tightens up again. It's probably going to push a little bit higher. It will broaden out substantially before it breaks down. So we want to watch that. But ultimately, I do think it targets 63.72. And now, as far as strategy, buy any breakout, I pretty much had that formatted. Any breakout above this could be about 53 bucks, 53.23, I think, if I remember right. So you can buy the breakout or scale into a position here. I prefer to buy the breakout, because then I have some conviction that we're actually moving in that direction versus chop. That's the reason we look at that difference. Because if it's not going to move and just sit there, I'd rather put capital to work out sort of that. All right, let's look at OMFL. Very similar look, except for we really don't have a breakout here until about 55 bucks. But we got some nice upside, nice trend channel forming here to the upside. Quite often those trend channels start like this and then they get a breakout. So start like this, maybe we get our breakout here towards 67 pretty quick. So now you either can buy your breakout here, wait till here, or wait till here. That really is or do all three, which actually sounds better now that I say it. Put a piece on here, add a piece here, add another piece here on those breakouts. And then we should get at least our intermediate wave 3 around 60 bucks to the upside first. Looks pretty good to me. Only get concerned if transport breaks. However, if you're doing calls on OMFL, which there were some there, it wasn't as fat as some other strikes in different instruments. But if we break below this, I would cover those, below that 50 bucks. 50 bucks would be my stop, looking at that. All right, let's look at Pacer Industry. Now, we just poked our head above the breakout. I would like to see more FOMO coming into industrials here because it would give me more conviction that we're going to have some solid upside. Same thing with transports. And I would, even though I'm chasing gold, I would rather gold back off as well because in my view, gold and transports are telling us a different story than what the indices are telling. They are telling us that we're going into a recession. However, industrials popping, which obviously is a number of stocks, could be experiencing the FOMO from the bull run that we've had in indices. So that it might sort of a mixed bag here. I would rather the transports and gold turn down, and then I would hope to see INDS, accelerate to the upside. But again, this might be one just sort of hangs out here, sort of like HYG now. We're getting a little bit of a bid, but at the same time, I don't know that it's going to recover. And I'm not sold the Fed is going to cut. I'm just being candid. Reason being is we still have a hint of inflation. We don't have major job losses. We don't have horrible numbers. We're nowhere near that 5.8%, which has been our historical norm for unemployment in the United States. And, the Fed even mentioned that, and I don't remember, it was the second or third meeting back, that, we're far below our historical mean. So, they're looking at that. I'm looking at that, and I'm looking at, these different sectors. So I think we need to chase more of those sectors. However, a safe place to put capital for somebody who is an ETF trader, INDS, I like it to the upside because it is going to recover, once the market starts moving in the right direction, if the Fed brings in stimulus, if the Fed cuts rates. So right now, the thesis is the Fed will cut rates by the end of the first quarter in my mind, a quarter to 50 basis points at some point. I don't think they cut before the election because it creates too much of a bias that they're political. I think that's the single greatest reason why they wouldn't do it. I don't see an excessive reason for them to do it, even with the job losses, even if they're freaking out, whatever. I think they would be better off offering some other form of stimulus in the market to stimulate jobs. Like, for example, offer tax credit to corporations for hiring new employees, as an example. Real simple move, doesn't cost them a lot of money, sort of is QE, but in a different form. But it would just be like what they did in the Great Recession in mortgage-backed securities. And bottom line, they allowed people to short sell their homes when they were upside and defer their interest. They just rolled it to the back of the loan. Would do the same concept and it doesn't cost the Fed. And I think that has been a great learning experience for the Fed. So, all right, we're looking for that 52.75, our primary wave 3. I would still buy the breakout on this, but I would probably stick to common shares or cash secured puts. You could target, maybe, coming here, 50s is probably a little extreme. I would go to the support at 46. So, I probably wouldn't go any higher than January 46 calls, and I'd stay light if I was going to go there. Tight, maybe even 45 calls, because there's, unless we get this kind of leg here. However, I'm going to come back to the same statement. When I say that about a chart that has a setup, it always goes against my view. So I don't like to insert that bias into a chart because history has taught me that when I get my setups, they work more often than not. This is a breakout setup. So in this scenario, with the back test of the breakout line, I would say there's probably a 75% likelihood that it breaks out the 50% fib to that 48.51, and I don't necessarily want to discourage people to put a piece on that. That's my thought. All right, looking at Latin America, little weak. Look at Mexico, even weaker, And I also wonder what happens when they join the BRICS. More of South American, states join that. How much that's going to have effect, because realize we're not saying it publicly as a country, but we're not giving any of the BRICS countries any benefits, nothing. I doubt that they can even get funds from IMF at this point because they're not part of the team. That makes sense. So. But we've got a new primary wave setup on ILF at the 2251. Decent back test. Count showing me that we break out to 37 from here. So buy the breakout and or cash secured puts, anybody at this point. Really right around that 2650 is our breakout there. I would not have a problem putting a piece on here. All right, let's look at Vanguard VPL. I don't know if you've caught the theme yet. The best looking charts are sector specific, aka real estate, industrial, aka country region specific. The reason being is those seem to be the areas that are going to be the big benefactors of where the Fed is moving. Now we've broken out above the breakout, broadening a little bit. So this is, we still could backtest trend support. I would like this much better at trend support, a little lower. I'm getting a backtest wave 2 down around 66.56. So if you don't have a position, I would hold for that. If you do have a position long and it breaks below the breakout, right, I would sell a block of covered calls to cover your position. And that's how I would manage VPL. All right, let's go to A1A. Now, this has been Kirk's favorite, or one of Kirk's favorites. At this point, our 2 was shallow. Now, that always, whenever we do not complete a count, it either implies a bullish bias or a bearish bias. In this case, it was shallow to the back test. So this adds a bullish bias to Asia. Now, even though this covers all of Asia, South Korea is booming a little bit. I guess we're moving more troops in there and other capital, air defense systems, etc. Obviously that cash trickles down to their economy, jobs, etc. Japan also is in a scenario where, they've got a little bit of inflation there, so they've got, they're trying to drive in some more capital in there. So, I think sectors, areas of Asia should do well. So, however, I prefer it at the 58 buck, but as long as it doesn't break below this low here, that right at the 23.6 fib, I think we're pretty good. So you can sell some cash secured puts down at 60 bucks or 58 bucks. Or you could buy common shares. And I would even at the breakout, think about adding some $70 calls up there once we get up there, even now, the way the chart looks, and try and capture that upside. Because here again, I do think Asia comes in and gives us something, of a pump. So close above, I've got it tagged at 68.50 for the breakout. Then we should head towards our primary area of 3 around 85. Now, if you're really aggressive, this is one where you could just say, okay, instead of putting 25 grand in this stock or 5 grand or whatever your number is, I'm going to put 1,500 in January 2026, $85. Okay. Now, and I'm just talking about this as the math, because a trade or a position trade is, risk versus reward. The ironic thing is we're wrong a lot, right? And wrong a lot. Sometimes we're wrong 20% of the time. Sometimes we're wrong 30% of the time. Sometimes we're completely disconnected from the market and we're wrong 50% of the time. Most of the time, I'm not there. I'm usually higher. My low's been around 63% of the time. And I usually stay in the high 70s. But most of the time that occurs when my bias is not in sync with the markets, and which is one reason I do as much as I do, because I'm trying to stay in touch. I spend probably 35 or 40 hours a week just trying to stay in touch. So as an example, if you bought those January 26, $85 calls, the upside should be 4 to 6 to 8x. It manifests. If we get up to 70 bucks, 75 bucks, you'll be slightly in the money. You should see between an 8 and a 15% gain. So once it moves into the price window, you're basically buying time for a smaller percentage, thinking you get a higher gain. Whereas if you bought 25 grand worth of A1A and the stock grew at 8% for the year, obviously you had an 8% gain. You're not going to see the 10 to 15% gain on the risk capital that you've put on. By no means do I suggest you put on a full position. I look at these as lottos, but as the trend changes in certain sectors, those longer dated calls can become extremely profitable. For example, if we had put on $150 calls just January 2025, when the Vita was at 90 bucks, right? How much would those calls be? It would be about 4x, right? When we hit our peak, 138 or whatever that was. So, that is where this, so when we have that divergent lower low on the lows, that is really the time we want to put a piece on. Now, if you're uncomfortable going in that direction, so be it. That's fine. I'm not suggesting that everybody does that. I'm not suggesting this type of trading is right for anyone. What I'm saying is, if your book is fat and you've been booking a lot of gains and you're up 50% for the year, 20%, I would hesitate to do something, 30%, maybe half of that $1,500 long out on those 85. If I'm at 40%, hey, then I probably do the $1,500 towards the longer dated calls, or maybe even a larger position if I was higher than 50%. So my system works like a belt, or a balloon. When the system's working and the air is going into the balloon, it's getting bigger and bigger and bigger and bigger. And I expand my strategies in different pieces elsewhere as I have higher success rate. Same thing when the balloon or the bellow is decelerating, or the air is coming out of it, where our loss rate is accelerating versus our win rate accelerating, because there are times I'll be 100%, and then there'll be times, I will, on certain weeks, drop down to 30%. Hopefully, I've recognized that I should be out of the market, like really almost all of August. I should have been out of the market because the upside, even though we hit and we ended up, a decent number, I think it was like $17 or $18 in gains per option contract. So that, at the end of the day, it's a game. And we want to have a specific strategy and a repetitive method that we buy into these stocks, and we do the same percentage so you can manage risk. For example, when I was reviewing for swing trade notes yesterday, and usually I do it in pieces. I do a little bit Friday, a little bit Saturday, and then before I do the article on Sunday, I do it again. So, I may have 7, 8, 9 hours in review I do or more in looking at specific charts. And a couple of the charts I really liked had outlier pricing on the capital or risk capital I needed to put on for a trade. $2,100 a contract, $2,500 a contract. And then looking at the movers, when you're dealing with the bigger plays, you have bigger losses. So if you're buying a strike on a share or a stock, for $500 a contract, and then you have an outlier that has a similar setup and it's $2,500 a contract, what I like to do is keep the risk capital per investment equally the same. The only time that I expand on that is like what I did with AST Space Global. We got my flush to $24. I'd had it on the chart for a month, from the highs. You guys saw it, everybody saw it. I kept repeating it. I knew it was coming. And to be honest with you, after this bounce to $32, it's probably going to come off a little bit more as well. So when the legs occur, we want to make sure that we have equal position size. Another way to manage your risk. Not only that, it's easier to tweak, because sometimes, small caps, I got a couple small caps that I like. Actually, I've got about 15 names for swing trade notes this weekend. I'm not going to put them all in there. I'm going to break it down. I'm going to do one more run this afternoon, see if I find any more that I really like. And then I just pick out the top players that I really like. So we may end up with, 5 to 7 names this week, I think. But my point is you want a methodical, almost insane methodical, repetitive strategy. You do it the exact way, because when you recognize you're doing something wrong and you start taking losses in a certain type of trade, for example, over this last quarter, waiting for the back test has been very challenging because many names have just run. So what I end up doing is I've highlighted the name, I've got it on my watch list, and I'm watching it. I'm waiting for the back test, and the frickin' back test didn't come. I have a lot of names. I bet you I have 189 names in my larger watch list of names that had divergent lows on pullback for 50% back trade, and bottom line, they blew up. Thing is, I can't tweak the back test from the strategy because it is so significant in measuring the next leg. I have no idea where it's going to go without the back test until the back test comes in. Now, the back test may come in extremely higher or et cetera, extremely lower than it normally might be, because typically each leg has a range on the Fibonacci extensions with Elliott Wave. So, and, from that, taking outlier positions when your book is fat is part of building your strategies out. So you keep doing the exact same thing. So if you're playing around, let's say, for example, you've got 50 grand out of your book that you will use towards options. And I like different boxes. I like tight box. And then I've got a certain percentage. Let's say you have another 50 grand you want to sell cash secured puts on. Okay. Similarly, okay, I've got 50 grand I'll invest in selling covered calls. All right. You want to keep those books even, just like you want to keep the price value in those option value similar, so you can manage the box as you step up the ladder. By the time you get 1, 5, 10, or 15 positions on, etc., you now have what's referred to as a balanced book, equilibrium kind, because then you can see where you want to increase your position, much like we did with AST Space Global when we got our $24, because it was an extreme. Next couple of days, we got really close to $30. And, honestly, when I was, in hindsight, you'll see a couple of names this coming week where I've got 2 strikes on there. And the reason is because it helps capture the upside a little bit more aggressively when we really move. And in times like this, one thing that I've seen on these rallies, when we get these buying sprees coming into the indices, they're pretty big orders. I mean, they're moving it quick. I mean, just on the data that came in yesterday, Jesus, we had a 15-point range in the S&P. That was a nice quick move. I mean, I was able to capture a piece of it, only about 30% of the move, but still was able to capture a piece of it. Very aggressive move. So if I had dated puts in S&P before data came in, they would have really printed if I took them out, put them on at the prior day's high. Subsequently, at the lows, when we hit the lows Friday, if I had bought calls at the higher end of the range, they would have probably printed it as well. So just the look, and I went off base here on this today, but I wanted to. It was a good time. Actually, my blood pressure was good today. I woke up with 115/77 instead of 95/87. So I have a little more energy. Can you tell? All right, folks, that's what I've got for this week. Great trading. Until next time.